Hello, everybody. This is Bennett Tchaikovsky, and welcome. And we're going to talk today about intermediate accounting. This is going to be part zero, or our overview of earnings per share. So, my disclaimer and copyright notice: the information and opinions in this presentation are those of myself only and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I'll make reference to publicly available information that is the copyright of other parties. I do not claim any right to the copyright that I'm referencing in those parties. So, earnings per share, let's go to it. So, this is by far considered to be one of the more challenging areas in for the CPA exam. And it's kind of interesting because as I was going through and looking at UWorld, as far as where they actually put it, it's under public company reporting topics. And the great thing about, looking at this over here is that if, again, the reason why you want to go through and use CPA review is you will literally see, basically a 42-minute presentation, and then this one is almost like 30 minutes. So it's a more complicated topic, but it's probably going to be one of the most important topics. And the reason why is because when we think about companies, and if I just take a look over here at Tesla, let me find the right one. Hold on. There we go, Tesla. And if I were to kind of look at this and to go ahead and go look at their 10K, and when I look at Tesla's 10K, what you're going to find is right over here under the financial statements, you're going to look over here and they're going to essentially have a number, which is essentially for basically basic and diluted earnings per share. And the reason why this becomes so important is because when we look at certain metrics under, if we type in Tesla stock price, there's certain ratios where essentially when we're going through and looking at this, and especially this one right here, which is the price to earnings ratio. What exactly does this mean? This means we're taking the stock price and we're effectively dividing it by the earnings per share. Usually it's going to be on a 12-month basis. But when we do this, what this is going to kind of show us is that how overvalued or undervalued a stock potentially is quantitatively. And when we see this, what does this mean? Well, it means that it's going to take 326 years for Tesla to earn back a share of its stock. It's going to take 326 years of earnings to earn back that stock price. And if I look just by comparison, right, if I say Ford stock price, that actually has a negative PE ratio because they seem to be running at a loss right now. But let's go ahead and also look at Rivian. And this is going to be the other one that I want to show you real quickly. What you'll see over here for the price earnings, it's actually a negative amount. And usually it's going to say not applicable, but let's go ahead and kind of discover why that is. So Tesla had a PE of 326. And let's go ahead and take a look at Rivian. And why is it that Rivian and Ford, for that matter, why do these companies why are these showing as a negative price to earnings? Well, if I went over here and I'm looking at Rivian Automotive, and as I'm coming over here and I look at the financial statements, what you're going to see is that if a company is operating at a loss, right, then basically you're going to not have like the price to earnings should technically be not applicable. But again, it's when we're looking at the concept of diluted earnings per share, and we'll see that momentarily. When a company does operate at a loss, you're only going to need to compute basic earnings per share. But we'll get to that in a moment. But the earnings per share number, and I think what I want you to be taking away from this is that This happens to be one of the more important computations that we go through and do. Now, many of you have been exposed to earnings per share in your accounting 1A or accounting 1B class is simply, well, it's net income minus preferred dividends divided by the weighted average shares outstanding. And usually those values are going to basically be given to you, but we're going to be exploring in this video series kind of, well, what are the other parts that kind of go into this? So let's go ahead and take a look at this. Okay, so I'm going right back over here. So these are the essential formulas. Now, when we look at diluted earnings per share, this is our basic earnings per share is net income minus preferred dividends and divided by the weighted average shares outstanding. And the one thing you need to know about preferred dividends is there's a difference between cumulative and non-cumulative. What does cumulative mean? It means is there an obligation to go through and to pay these out. If it is in fact cumulative, whether or not they're actually declared or paid, we're going to go ahead and subtract them. If they are non-cumulative, then we only deal with it if they're in fact declared. Now, one of the more interesting ones over here is basically is when we look at diluted earnings per share. And the first thing you want to know is that if I am at a loss, right, you're done with basic, right? Because everything is going to essentially be, it'll be what we call anti-dilutive, and I'll show you that momentarily. But when we do have diluted earnings per share, what we have to kind of go through and do is to say, okay, well, what if we had some convertible bonds outstanding and those in fact were converted? How would that impact our earnings per share? So that's the kind of the formulas we're going to be kind of going through and looking at. So over here, we've got our anti-dilutive securities. Remember, if it's at a net loss, everything is going to be anti-dilutive. I'm just going to be reporting basic loss per share only. And then if it's basically, if you've got basic, if something is anti-dilutive, meaning that it's going to be increasing my earnings per share, then we're going to go ahead and exclude it. But if the diluted earnings per share is less than the basic, we're going to go ahead and include it. And again, when it comes to net losses, here at our friends at Snap, Crackle and Pop, let's just go ahead and take a look at these guys. So as you kind of see over here, the net loss per share is essentially going to be the same. The basic and diluted are the same because, again, anything would be in this case, if you're at a net loss, it would basically start becoming anti-dilutive. Okay, so going back over here to the anti-dilutive securities, and then what can basically go through and dilute my basic earnings per share? It can basically be stock options, stock warrants, convertible bonds, convertible preferred stock, restricted stock units. You're going to see a lot of different terms out there, but the most important thing we need to kind of figure out is to get this information, what are the terms of it, and then how is that going to be, creating stock, basically where it could be potentially be dilutive. So in terms of some other key things when it comes to the weighted average shares outstanding, is that when you have a stock dividend or stock split, we're going to basically essentially make it retroactive to the very beginning of the year. Any kind of new share issuance or treasury stock buybacks, we're going to be going through and, well, if we started out, and you'll see the examples we'll be going through and doing, if we had, say, 1 million shares at the very beginning of the year, and then, well, if we issued some on March 31st, then these are only going to be outstanding for, three quarters of the year, or from April 1st to December 31st. And what's really important here is that, so say if 2027, we report earnings per share, if later on we go through and we then say, okay, we do a stock split, what we have to do, and if the stock split occurs like the following year towards the end of it, we have to go back and restate our earnings per share so that our earnings per share on the income statement is going to be comparable. Remember, that's one of the enhancing qualities when we're going through and preparing financial statements. So thank you for watching. Please make sure you like and subscribe. Feel free to leave a comment or email for me at ivc30 to cpa@gmail.com. Now, one thing I want to just kind of mention here really quickly is that this is a very brief overview. And the way that I want you to really learn earnings per share is going to be going through and learning by problems. And so that's what we're going to be going through and doing next. I'll see you on the next video.